cash flows, time value of money, and margins. Cash flows, they had several criteria that they expected the cash flows to meet. It should be explicit. You should make an explicit assumptions of what your cash flows are expected to be over however many years, over the life of the contract. To the extent possible, they should be consistent with observable market prices. So we may not have observable market prices for something like mortality, but interest rates might have observable market prices. Maybe equity volatility might have an observable market price. Maybe inflation. So wherever possible, be consistent with observable market prices. They want them to be unbiased. Basically, they want you to, or suggest, projecting the cash flows over multiple scenarios and then taking the mean of those cash flows, of the average cash flows, in order to project out, in order to determine what your liability is. A lot of U.S. GAAP goes in terms of best estimates, and it's just a single best estimate. What do you think is the most likely case? The ISB didn't want to do that because they didn't want to ignore the extreme cases that might be rare but might have a big impact on if they occur. They want the cash flow estimates to be current, so not locked in. Like FAS 60, you might have locked in estimates. They want you to update your estimates each period so they're always current. And one of the controversial points was they shouldn't be entity specific. So, you know, if that's something like interest, maybe you could see interest, that necessarily wouldn't necessarily be an entity specific cash flow. But something like mortality, should you use your own mortality assumptions or try to estimate what someone else's mortality might look like? Probably use your own mortality in that case, because the point is, if somebody else was to buy this, remember you're estimating a transfer price, they would probably look to your mortality experience to buy your block of business. On the other hand, expenses might be a little bit different. For expenses, if someone else was to buy your block of business, they might have a different expense structure than you do. And so your expenses might be irrelevant. So the discussion paper was saying, don't use your own expenses if they're different from what another market participant would assume. So that was somewhat controversial, and it's actually been addressed somewhat in the redeliberations. Second building block is time value of money, discount rate. From a life insurance perspective, it's probably not controversial, but I understand on the P&C side, many liabilities are not discounted. They just use the undiscounted cash flows. And the discussion paper said, no, you should discount cash flows for all insurance liabilities. The discount rate should be consistent with observable market prices, assuming that the terms of the obligation are the same as the one you're measuring. They also talk a little bit about own credit, which has been an issue under fair value, and mention that you should incorporate your own credit standing. In other words, your risk of default somewhere, whether it's in the discount rate or it might be in the cash flows themselves. But you shouldn't ignore it.
Sorry, for the time value of money question, I know that a lot of times companies don't apply time value of money for like pending lawsuits and things like that. Are they supposed to start doing that now?
Well, if you're talking about pending lawsuits, that's actually wouldn't be covered by this standard.
Okay.
But
that's what I'm asking.
Well, if you're talking about liability for pending lawsuits, it's different from yet another project for contingent liabilities. But if you were a P&C company and you weren't sure how much you were going to have to pay as a result of the pending lawsuit that you're insuring, they would say, no, you should make an estimate of how much you're going to receive or how much you're going to have to pay and when, and discount that back with that. And put in a risk margin, which is the next slide.
Okay.
Another thing they say, and this has been controversial, is that the discount rate should depend on the assets in most cases. So just because you're going to assume you may hold assets, you're assuming they're going to earn 8% or whatever, that shouldn't necessarily drive your discount rate. For most products, if they're linked, like a variable annuity, yes, that's okay, but if there's no direct link between the assets and the liabilities, then the discount rate shouldn't be necessarily linked either. The third building block is margins. And again, it's talking about property and casualty companies, and a lot of the claims liabilities are not discounted, but they also don't put in an extra margin. Basically, that is their risk margin, is the time value of money that they're not discounting for. But the ISB in the discussion paper said, no, you need to have an explicit risk margin, which is an unbiased estimate of the margin that a market participant would require for bearing risk. So the point being, if you had a guaranteed $100 in a year, or maybe you get $0 or maybe you get $200 in a year, those don't necessarily have the same price. And to the extent one of those cash flow streams is riskier, you would have to build in a margin for that and somehow estimate what that margin would be. I don't think anyone's figured out quite exactly how to do that, but we have to figure something out. I think the International Actuarial Association has published a really thick, fairly dull paper, but a lot of good stuff in there if you actually can keep awake through it. But that's really not just one approach. They talk about 10 approaches how you might estimate a risk margin for insurance. They also talk about you might need to estimate a service margin, include a service margin, which would just be the margin that a market participant would require for performing those services, like other than insurance, such as if there's investment management services that are, or asset management services within that contract, that might have its own margin. Policyholder behavior was a big deal within the discussion paper. A lot of words spent on that. But basically, what the discussion paper said was that when you calculate your liability, let's say you have a universal life contract or a whole life contract that you expect to get premiums over many years, you would not include future premiums in that liability calculation unless one of 3 criteria were met. You can only include those future premiums if you can compel the policyholder to pay the premium, which is pretty rare. If paying those premiums and paying out the expected benefits related to those premiums would increase the liability, that would be okay. So if, let's say it was an impaired life, if you pay the premium, the benefits that are associated with that premium are more than the premium on a present value basis, yeah, you should include that. You shouldn't understate your liability. And even this was controversial within the ISB. A lot of ISB members didn't want to go even this far. If paying the premium would guarantee future insurability, so let's say a whole life contract, if you pay that, in order for the policyholder to retain their guaranteed insurability, they need to keep paying their premiums, that would be allowable too. But for universal life, I think at least many of the industry interpreted what they said as being basically you'd only be able to assume premiums up to the point that it would keep the contract in force. So just because you expect policyholders to pay more premium than is absolutely required to keep the policy in force and build up a fund value that would then be drawn down as the policyholder got older, that wouldn't be recognized. On the other hand, and also policyholder behavior, like lapses on a lapse-supported product, you basically have to assume that policyholder behavior would be efficient, that policyholders wouldn't lapse on a lapse-supported product. You'd only recognize lapses to the extent it increases your liability.